Imagine waking up one day to find your savings worthless and your job gone. How did America's first economic disaster unfold, and could it happen again? Stay tuned to find out. The early 19th century saw an economic boom in the United States, fueled by post-war optimism and rapid expansion. Following the War of 1812, the U.S. experienced a surge in economic activity. Technological advancements, such as the steam engine, and infrastructural improvements, including the construction of canals and railroads, played pivotal roles. By 1818, the U.S. economy was growing at an annual rate of approximately 7%, reflecting unprecedented prosperity and a booming real estate market. Langdon Cheves, president of the Second Bank of the United States, became a central figure during the crisis. Established in 1816, the Second Bank was designed to stabilize the nation's currency and economy. By 1819, it held assets worth approximately $35 million and played a crucial role in regulating credit. Cheves's attempts to tighten monetary policy and curb inflation were both pivotal and controversial. In the early 19th century, American banking was characterized by a lack of uniform regulation. State-chartered banks, which issued their own notes, proliferated, leading to a fragmented and unstable financial system. By 1819, there were over 200 state-chartered banks with combined assets of $100 million. These banks issued notes beyond their reserves, inflating the money supply and creating a precarious financial environment. Land speculation was rampant during this period, with investors pouring money into Western territories. The federal government sold land at $1.25 per acre on credit, fueling speculative buying. Notable speculators like John Jacob Astor and Daniel Whitney amassed significant fortunes, but when land prices collapsed, many faced insolvency. For instance, Whitney's investments in the West led to losses estimated at over $1 million, a staggering sum at the time. Internationally, the post-Napoleonic War recession affected American exports. European countries reduced their imports of American goods, including cotton and tobacco. This led to a decline in export revenues by approximately 30% between 1816 and 1819. The global economic slowdown exacerbated domestic economic troubles, compounding the crisis. The Panic of 1819 did not discriminate, its effects were felt across all levels of society. Let's start with the plight of American farmers, who were among the hardest hit. The rapid decline in land values led to widespread foreclosures. In Pennsylvania alone, over 25% of farms went into foreclosure by the end of 1819. James Smith, a farmer from Lancaster County, was emblematic of the struggle. Smith had taken a loan of $5,000 to expand his farm, but as land prices plummeted, he found himself unable to make payments. His farm, once valued at $10,000, was auctioned off for a fraction of its worth. Urban workers also faced severe hardship. The manufacturing sector, which had been booming, saw significant downturns. In Philadelphia, factories reported a 30% drop in production and a 20% reduction in their workforce. Many workers, including John Thompson, a mill worker, faced unemployment. Thompson recounted how his once stable job vanished overnight, leaving him to scavenge for any available work to feed his family. The crisis also triggered widespread social unrest. In New York City, protests erupted in early 1820 as unemployed workers clashed with authorities. These protests highlighted the growing discontent with the economic conditions and the perceived ineffectiveness of government measures. The economic sectors were impacted unevenly. The agricultural sector faced the brunt of the crisis. Cotton prices, which had reached 30 cents per pound in 1818, fell to 10 cents per pound by 1821. This drastic price drop led to a significant reduction in income for Southern farmers. For instance, in Alabama, a major cotton-producing state, the average income from cotton fell by 60% during the crisis. Manufacturing, which had expanded during the War of 1812 due to wartime demands, now faced severe contractions. Factories in New England, particularly those producing textiles, saw a 25% reduction in output. The closure of several small factories led to increased unemployment and economic distress in industrial towns. Trade suffered as well. The volume of shipping activity in major ports like New York and Boston declined by approximately 30%. The decline in export revenues was exacerbated by the global economic downturn, which reduced demand for American goods abroad. The regional disparities in the impact of the Panic of 1819 were stark. The western states, heavily invested in land speculation, were hit hardest. Foreclosure rates in states like Ohio and Indiana were particularly high, with estimates suggesting that nearly 50% of landowners faced foreclosure. The collapse in land prices led to economic stagnation in these regions. In contrast, the North, with its more diversified economy, experienced less severe effects. While manufacturing output declined, the region's economic resilience was greater due to its industrial base. The South, however, faced a severe crisis due to its reliance on cotton. The drop in cotton prices had a cascading effect on the regional economy, leading to widespread financial difficulties. In response to the economic turmoil, both federal and state governments implemented a series of measures aimed at stabilizing the economy. The Second Bank of the United States, under Langdon Cheves, took several critical steps to address the crisis. The bank tightened credit, calling in loans and reducing the money supply. This was a necessary but painful measure intended to restore confidence in the financial system. By mid-1819, the Second Bank had reduced its circulation of notes by 20%. State governments also took action. For example, New York passed the stay law in 1819, which delayed foreclosure proceedings for 1 year. Similarly, Pennsylvania enacted laws to provide temporary relief to debtors. These measures aimed to prevent mass foreclosures and provide some breathing room for struggling individuals. The federal government also responded with policy changes. The 1816 Tariff Act, which imposed higher tariffs on imported goods, was intended to protect domestic industries. While it provided some relief to American manufacturers, it also led to tensions with trading partners and complicated international relations. The government's responses were not universally welcomed. In the wake of increased foreclosures and economic hardship, public protests and political movements emerged. In Pennsylvania, large-scale protests occurred in 1820, with thousands of people marching to demand relief from foreclosure and debt. The Anti-Bank Party, a political movement critical of the Second Bank of the United States, gained traction during this period. The party argued that the bank's policies exacerbated the crisis and called for significant reforms. In the South, the situation was equally tense. Farmers and plantation owners, reeling from plummeting cotton prices, expressed their frustrations through petitions and public demonstrations. These protests highlighted the deep-seated dissatisfaction with both federal and state responses to the crisis. The Panic of 1819 led to intense debates about economic theory and policy. The crisis exposed the flaws in the banking system and the dangers of speculative bubbles. Economists began to discuss the need for stricter financial regulation and better oversight of banking practices. The period saw the rise of arguments in favor of a more regulated economy to prevent similar crises in the future. The debates also touched on the balance between government intervention and free market principles. While some argued for increased government control to stabilize the economy, others advocated for minimal intervention, believing that market forces should correct economic imbalances naturally. The long-term effects of the Panic of 1819 were significant. The crisis led to the development of a more regulated banking system and financial practices. The establishment of the National Bank Act in 1863, which created a national banking system and introduced a uniform currency, was a direct response to the issues revealed by the panic. The crisis also influenced future economic policies and reforms. It highlighted the need for financial prudence and regulatory oversight, shaping the evolution of banking and financial regulation in the United States. These changes aimed to prevent the recurrence of such a devastating economic collapse. As we reflect on the Panic of 1819, we see its profound impact on American history and its lessons for modern times. By understanding these past events, we can better navigate today's economic challenges. If this deep dive into America's first major financial disaster has intrigued you, please like, subscribe, and hit the notification bell for more insightful explorations into economic history. Join us on Archivist Animates for more in-depth historical analyses. Stay curious and stay informed.